Got
We
mine.
are live on Oz Property Investors. We bring the big names and we have the big fun on Wednesday nights. How's it going, Melinda? How's your day?
Very well. I've had a very busy day, but I'm excited to be here, and I've got lots of info to share with everyone. So hopefully it adds some value.
Wow, that's we actually didn't try that share screen before, so hopefully your tech is going fine. But I'm sure it will. It will 100% work.
We will
So
work
Joe,
it all out.
it's good to hear, and it's exciting to hear that you get people to talk about your business as well, and sort of work through that. And that's I love kind of strategizing. And Joe and I are strategizing too. So how are you going, Joe? How's your day, man?
Mate, I'm very good. We're back in the office now. We're office dwellers, and it's a different world. It's a different world back in the office. Like it's trying to get used to it again.
I must say,
but I'm loving it. I'm loving it.
Yeah,
Love the team. Great team. That's what you need. Great people. Great team to be around. So that's all you can ask for. How's your day, Jeff? Little work from home, buddy.
It's not as good as the Oz property team, though, is it? You've only got 2 of us, and three of us actually. Nick, I suppose, on that. My day was really good. What did I do today? It absolutely flew by. I went to all the chores that you do when you're working from home, like going to the butchers, going to Dan Murphy's, doing all that good stuff, you know. And what else did I do? Just did heaps of cool things, and actually did some work as on stage well for anybody from my work who's watching. I don't. Yeah. So great.
Well, I'm excited for this one, mate. I'm very much excited for this one. This is actually going to be one of the biggest live sessions that we've ever run. We are going to have a Brisbane Breakdown with Melinda Jennison. Am I saying that right, Jennison?
Yeah, Jennison, that's right. Yes, you can blame my husband for that.
So we always like to start, we always like to be grounded. So let's talk about our quotes of the week. Melinda, have you got a quote? Have you got a quote there?
I do have a quote. My quote is by Napoleon Hill, and the quote is, "The way of success is the way of continuous pursuit of knowledge." And that comes because of my background in research, and it's a philosophy that I sort of follow personally. So there's my quote.
Oh, wow. I like that.
I thought you were about to go down the I was thinking of Henry Ford, where you think you can or can't, you're right. But that's an is that from, I mean, anyway, we could talk about that quote. Joe, what's your quote? Sorry, I love quotes.
I need to get my quotes again. I'm more of the, like, if it's centuries old, like Napoleon Hill, very old, like it's from the 30s or the 20s or something. So if it's lasted this long, it's got to be good. So my quote's from Seneca, and it is very much, I think it has something to do with property, but luck is preparation multiplied by opportunity.
Oh, there you go. Leverage.
Everyone likes a bit of math.
That's a good one.
Everyone likes a bit of math in their quotes, but it's 100% right. We see so many people in this group that take action, that get educated first. They get educated, then they take action, and then if they're unable to do it, they hire experts like Melinda to help them do it. But that's how they become so lucky. And then 5, 6, 10, whatever portfolio they get, they then start hearing people, "Oh man, you're so lucky," or "Lady, you're so lucky." So I like that quote. I'm all about it. Jeff, what is yours? What is yours?
So I don't know who to attribute my quote to, but I could probably look it up. But
let's go unknown.
Yes, unknown. Maybe I could claim it. So my quote is, "If you show me your friends, you'll show me you can show me your future." So it's kind of a take on the old, the average, the 5 closest people, 5 people you spend the most time with. Mm-hmm. But I like that one though, because it's sort of, and it's not to disparage if you've got somebody who's not as a positive influence in your life. It doesn't mean you have to sort of cut them out immediately, but it just kind of
give it time.
It keeps you mindful of the people who we hang around with. They create the energy and all that kind of good woo-woo stuff. I mean, I like that word woo. It just gets me excited when I hear that word woo.
I'm all about the woo-woo, mate. I'm all about the woo-woo.
Before we move on, we want to see some we've got 50 plus people on the live already. This is going to be huge, just massive, bigger than probably the biggest and best one we've ever done. So throw your comments, questions, thoughts. If you don't like my hair, get me to get a haircut. Throw a haircut. I do need to do that at some stage. But Joe, over to you, mate. Tagging you in.
We're going to do our first sponsor. Before we do that, let me get it ready. We are having some technical issues on.
Joe's extremely grounded.
I'm very grounded.
It's going to cost us a week. Cost us a week.
Oh shit! That is the wrong one.
Commercial property offers the highest cash flow in Australian property investing, offering exceptionally higher yields than residential. Now, we're talking 8 to 10% net yields. That's cash after all expenses, not this 2 to 6% gross that we see in the residential space. So for those that are starting out on their commercial investing journey, it can be exciting, but it's also a step not to be taken lightly. The expertise of a commercial buyer's agent can pay dividends to help you secure that high cash flow and high growth potential property. And this is why we recommend Steve Polisi of Polisi Property. With over 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He has seen it all and knows the best locations right for growth. In a previous life, Steve was a chartered mechanical and structural engineer, so he draws on his mathematical and analytical skills that he's developed to break down what works best in commercial property. As with engineering, same goes with commercial property. It's based primarily on the numbers. So if you're curious about diversifying into commercial property, you have access to $100,000 in cash or in equity, book a call with Steve today and find that perfect asset for you.
There we go.
There we go.
I was going to pop the code for his book, but I realized it's a different one. So, yeah. Speaking of analytical, Melinda, let's get on to the person, the lady of the hour, the person of the hour. We've got So speaking of, it might even be sort of 2 hours, minute how long we end up, how many questions do we have? But I want to give you. I was reading about your bio, and I sort of know we've known each other for a while, but you from a very young age, I'll give you an intro. This is from your website. You developed an interest in real estate because your parents were property investors, so it runs in the blood, and you learn a lot from the conversation you had growing around the table, and it led to you buying your first home in Brisbane at the age of 18. That was probably just a couple of the start of the last Brisbane boom, I would say. But this is
before that, unfortunately.
Yeah.
Thanks
but
for
no,
the compliment.
so you've beginning of your journey, and you come though from a research analytical background. So you did a Ph.D. in 2001. Like that's amazing. Like I just have so much respect for people that have the dedication to be able to do that. And then instead of staying in that though, you moved into real estate, and you looked at the building construction and property development. So you've got that kind of diverse skill set of not simply being somebody who's been an investor. You've got some runs on the board in a lot of different gamuts. So, and you now lead the team of, or help lead Streamline up there, or you probably do lead the team. So Scott takes a backward step, and you are the leader of that team of Streamline up there in Brisbane. So that's exciting. Like, what is something that I miss out though that gets you most excited about your own journey?
Look, I think like anybody, it's where you start that makes the biggest difference. And you're right, my parents were property investors. So, I grew up, my dad used to own a lot of flats or, small blocks of units throughout Brisbane, and we had to do the hard yards. And they were in times where interest rates were 17+%. And I remember it not being an easy journey for my dad, but I also remember accompanying him in the days where you had to knock on the door and people paid cash for their rent. And, I remember having to go on my weekends and mow and weed the lawns. Now that contributed to a mindset for me of just not wanting to be a renter. I really wanted to be a homeowner. So, when I moved out of home, we decided, so Scott and I decided to buy a home, and, that was our first step into the market. And being Scott's a licensed builder, so having that skill set enabled us always to add value to our homes. And that was the starting point for us to continue to build, I guess, a portfolio. And, our strategy has always been to manufacture equity along the way. So, buy, renovate, buy, redevelop. And we've done that with every asset that we have owned. So it's just something that, we've taken on a journey, and we diversify through strategy rather than through location. And it's been a good journey for us so far.
How long into the journey did you kind of, when you bought your first property, was that I'm already in the property space, I already understand property, and this is where I'm going to take it? Or did it take a little while from that first purchase to be like, oh, actually, this is where we're going?
No, the first purchase was really, I don't want to pay rent, because I felt that rent was dead money, and that was just the mindset that I grew up with. But that was a property that we renovated, and we decided once we had paid off that property, and this is back in the day where you could buy a decent asset within 10 kilometres of Brisbane for under $100,000. So definitely a little bit longer than that last boom, but thank you for the compliment, Jeff. I may not appear as old as you may think, but I'm definitely, going back a little while. But since then, of course, that was the starting point. We jumped into the next asset, and it wasn't until we then purchased sort of where we are now, which is 4 kilometres from the city on a large 810 square metre block. And we really understood the power of equity and how you could use that equity. And this is back in a day when lending was very different, and serviceability was actually not something that was as important to prove. So you could actually borrow and leverage off the equity that you had built in your portfolio. And that was a way that we could really kickstart the investment journey. So we used our personal home as the starting block, if you like, to continue to build out a portfolio.
Wow. So you haven't had to chip in any other deposits from since then? Like, obviously you're going to have capital for the work and stuff, but like getting that deposit, getting that first property was the cornerstone for the whole portfolio.
Absolutely. Yeah. And I think that, all the way, because of the assets that we've chosen, we've been lucky enough to have that equity to be able to leverage. And that's the hardest thing for most investors, is saving for that deposit and choosing the right assets that will enable you to continue to build on a portfolio. So, we were very lucky with the first home that we bought. It was in a location that delivered some strong equity growth. We'd manufactured some equity in that process as well. We actually sold that to upgrade, wish we didn't now, because we can understand and know what that property would have been worth. But in the journey, we all say that. We all have our regrets. But, I think that we learn through our own investment journey, but then we also develop knowledge as we go through understanding what works and what doesn't work.
One thing I just want to ask about is you said rent money's dead money. You used to believe that. Do you still believe it now?
Look, no, I think it depends on an individual's personal circumstances, to be absolutely honest. And I think that there's a real place for rent vesting for some individuals who may want to live in a certain location but can't afford to buy there. And I think that the right strategy for an individual depends on their personal circumstances. So now, as a qualified property investment advisor, there's always a place in some people's investment journey to rent vest. And it just comes down to understanding, what the unique circumstances of an individual might be.
Yeah, great. Thanks, Aaron. So taking it back to that first purchase, or once you decided to go down the investment route, did you intentionally think about how many properties you wanted, or how did you go about building?
No, we never had a number in mind. We just had a strategy in mind. And, the strategy for us was more around selecting the best assets that our money could buy, and being able to monitor the position of that portfolio and continue to add other properties when we could afford to do so. And that's changed with life. And, this is the way I continually advise clients today. Having a plan written out is all good and well, but life throws curveballs, and life doesn't always go according to a written plan. And it's really important that you adapt and pivot and build a portfolio that's relevant. And a portfolio that's relevant depends on what you're doing at a particular point in life. And we work with investors now who might be young single professionals, and of course, when we're discussing a plan for them, we always talk about the fact that, well, next year or the year after, there may be a partner, there may be children, there may be a job change, there may be all sorts of things, there may be another pandemic. And a written plan won't allow for all of those variables. And it's really important that people understand what they need to do to control their own portfolio to achieve the goals that they're setting out.
Yeah. The way I like to think about planning is, like, it's awesome to have a plan. It's awesome to get it all structured out, written down, but the next purchase and the next purchase are probably where you should be having the most amount of focus. And then everything else looking beyond that gets very blurry, and you can't really connect too many of the dots because you haven't done the first step or the second step, which is that first property and that second property and then that third property or wherever that sequence is. And then it's very blurry and far away. And then it's only until you get to that point that, oh, now it's becoming a lot clearer because I've got all my resources here.
And the other thing is we rely on, the unknown when we're building out a plan, and we can project all we like, but there's no guarantee that our projections are accurate. We can never guarantee that we're going to secure a tenant and have zero vacancy, or that the rent's always going to remain at a particular level, or if we've factored in rental price growth of X amount per annum, how do we know we're going to achieve that? And it's the same with capital growth. There's no guarantee that past performance is an indicator of future performance. So it's understanding how those variables can change, and adapting and pivoting as you need to based on the true performance of any properties that you've added in your portfolio.
Yeah, it's interesting because I've got a post coming out tomorrow that looks at, because I see a lot of people saying, I've seen 30% growth in 18 months or 10% growth in the last 3 months, and it concerns me a little bit because I looked at the post I've got coming out tomorrow will make a lot of sense when you see it, but you look back at Brisbane, and I'm not picking on Brisbane here, I'll throw some other examples out the door. Brisbane from 2009 sort of around that to around sort of 2018. Grew maybe, and we're talking medians here, so it's imperfect science. And even Sydney from 2003 to about 2010-11 grew maybe 30,000-40,000. And you look at Perth grew probably, it was 480k in 2008, 2009, and 2019 it grew about $10,000. And of course that dips probably sort of to even sort of low fours, high threes. So it's kind of hammers home your point. You can't necessarily plan a lot of these things. And
I think a lot of the national news headlines talk about the Australian property market, and it's absolutely nonsense. There is no Australian property market. There are certain things that will provide some macro indicators for the performance of the overall property market, but the performance of different markets, meaning different cities and different parts of different cities, depends on local drivers of supply and demand. And Jeff, to your point, Brisbane underperformed compared to other major capitals throughout a 10-year period between about 2010 right up to, just this recent boom. Now, there were reasons for that. Now, 10 years ago, we had a significant weather event that caused a major flood. Now, that impacted our property markets for at least 3 years. And of course, that decreased the desirability for a lot of people wanting to, invest, relocate into our city. Then we had a change in our city plan, which came through in 2014. And as a result of that, a lot of land was rezoned, and we saw a lot of previous industrial zone land changed to high density residential land, especially in inner city precincts. And because of that, we then had developers that were building a lot of high density units, and we had an oversupply by 2016. We simply had too many units and not enough demand. And that's what saw some price softening. And a lot of people that bought off the plan, defaulted on settlement because they simply couldn't get the valuations to stack up because there were not enough buyers. So supply and demand at a local level has a huge impact on which way property values are going in terms of growth, but also in terms of rental prices, because an oversupply in the inner city unit market resulted in peak in vacancy in the inner city and middle ring housing market, because a lot of the developers put on incentives to encourage renters to move into the newly developed units simply because they couldn't sell them. So they decided to rent them, and that left a spike in vacancy in the housing sector. Okay, and when you have high vacancy, it becomes a tenant's market whereby there's downward pressure on rents. So you can see how supply and demand and understanding at a local level the impact of those two elements can influence not only an investor's return in terms of rental income, but also an investor's return in terms of capital growth.
Yeah, there's a lot to unpack in that. But
absolutely.
Thanks for sharing that. But I'm excited to do, this is what this is, right? This whole session is a Brisbane breakdown. And I would love to get like a holistic overview of Brisbane and what it is, how it works. So let's just make the assumption that we have a whole heap of people from Sydney and Melbourne, and they've all got their Sydney and Melbourne hats on, and they have never looked at Brisbane before. They don't know anything about it. And I think you're the best person to tell us all of the exciting things that Brisbane has to offer, but also like just to understand it a little bit. Because, I mean, where's the best place to start? Maybe that's the question.
Okay, I've got a map here that will help to identify Greater Brisbane. I think a lot of people get confused about Brisbane versus Greater Brisbane. And when we look at CoreLogic data, which is the data that we all rely upon to help us understand property trends, we're talking about. I'm sorry?
Which is not always that reliable necessarily, but
well, that's why I wanted to share this and help you understand the areas that make up that CoreLogic data. So hopefully,
this works.
This works.
I was going to say, Joe, rather than being from Sydney or Melbourne, could we be from Mars or could we be from somewhere else? I don't want to be from. I mean, I love Sydney and Melbourne. But there we go. Let's
You can see this.
I can. I'm just trying to get rid of our. Let me make it full screen.
Oh, there you go. Beautiful.
Awesome. Okay, so this will help people understand what actually makes up Southeast Queensland region and what actually makes up Brisbane. So Southeast Queensland as a whole is made up of 12 council regions. So you can see from Noosa in the north right down to Gold Coast in the south. Now, Greater Brisbane is actually made up of 8 council regions. So basically, out of Southeast Queensland, the 8 council regions that make up Greater Brisbane include Brisbane itself. This is the Brisbane local government area, Moreton Bay, which is to the north and sort of borders the Brisbane LGA and the Sunshine Coast. You've got Redlands to the east. You've got Logan to the south. You've got Ipswich to the southwest. You've also got the Scenic Rim, the Lockyer Valley and Somerset. Now, those locations that I've just highlighted incorporate over 17,000 kilometres squared in area.
Wow.
And that is what CoreLogic uses to provide Greater Brisbane data.
Wow. So they're talking about sort of places down the Scenic Rim in that.
Yeah, so what we've got to remember is the population density in some of these locations is very low. So when we're looking at transactions, they're going to make up a much smaller portion. So when we're looking at a median value, it's really not going to have a significant impact on the data. But what a lot of people don't realise, especially in the inquiry that we get, is that the Brisbane LGA, which is this small area here, and when we talk about the median data for Brisbane, it's actually the median data for all of Southeast Queensland except Gold Coast, Sunshine Coast, Noosa and Toowoomba. So people talk about, well, I want to buy something around the median, but I want to be within 10 kilometres of the CBD. Not possible. Not possible. So I just wanted to help you understand that. So 7.7% of this total area is actually made up of the Brisbane local government area. So, and yet
why is there so much confusion around that?
I've got no idea, because I think that I actually can't answer the question, but I did reach out to CoreLogic myself because in some instances what we're seeing, and predominantly we operate in this region and certain pockets within Moreton Bay. So when we see the data coming through, we don't understand some of the trends that we see sometimes because this is what the data's reporting on. And so I think it becomes very relevant in understanding not just what's happening in Brisbane, because Brisbane is not one property market. It's understanding what's happening in some of these areas around Brisbane and then breaking down that data further. So that just gives you an indication of, where we are and what makes up Brisbane. So I hope that's sort of a little bit helpful.
Yeah, there you go. I learned something today.
Yeah, and if we looked on that map, like from a like a camera overview, a lot of those outskirts would just be green, really, wouldn't it? It'd just be greenfield site.
Absolutely. Yeah, absolutely. And I'm happy to talk a lot more about that tonight, just around, where the land supply is coming in the future. And obviously that potentially can impact on the future growth prospects, because remember, to see capital growth happening, we need to have limited supply and high demand. So if we've got high supply and high demand, we may not get the same growth indicators. The other thing that I will share is I've just brought some data in which we've pulled together today. Now, this is CoreLogic data up to the end of September, and I'll share this with you in 1 second. I'm just bringing it up on my screen. Hopefully this works.
I'm sure it will. No pressure. No pressure. Oh, here you go. It's up. Oh, wow.
Okay, so what we've got here is 10-year growth. So this is CoreLogic data, 10-year growth. I've just picked the top 3 versus the bottom 3 performing suburbs by each of the regions. Now, apologies, there's no reference to Redlands, and I have grouped Ipswich and Logan together just because it was easier for me to do that, and I simply haven't had time to collate all of this information since we chatted just recently to plan tonight. So the reason that I put this together is just to help people understand over a 10-year period the differences in the performance of certain locations. So this is Brisbane. Yeah, this is Brisbane LGA, and these are the top 3 performing locations. So you can see New Farm, Paddington and Milton, 151.8%, 130.2% and 128.7%. So to your point earlier, Jeff, where we have suggested that Brisbane underperformed over a 10-year period until this recent boom, that's not all of Brisbane. It's definitely not all of Brisbane. So it's understanding supply and demand drivers at a local level to understand which areas have continued to perform regardless of the overall Brisbane trend. So you can see, sorry?
As we're going through, Melinda, are you, because I mean, I probably know 1 or 2 of these suburbs or areas, but could you sort of talk us through what each area actually, I don't know how familiar you are, for
maybe
example.
Not all of them, but.
Oh, okay. Yeah. Maybe just 1 or 2 of them, I suppose.
New Farm, Paddington and Milton are probably all within 2 kilometres of the CBD. So your typical blue chip locations, and median values in these locations would be at the top end in comparison to most other suburbs around the city. So the greatest level of growth has been in the locations that are the most expensive locations, which is interesting, yes, and it's also in the locations where there's no land. You know, the redevelopment. This is housing data, not dwelling data, by the way. I just want to make that clear because I've separated it out for houses versus units, because they're two very different markets, especially here in Brisbane. So this is purely looking at housing performance, not units.
Have you got the unit data, or I mean, is unit data not worth talking about?
I do have the unit data, but I haven't collated that for you tonight, and I apologise for that.
No, don't. Sorry. So why is it that in Brisbane, like what I'm just looking at New Farm there at 150% or 151 versus something like Belmont or Rochedale. Rockadale, Rochedale. Why is there such a big disparity? Is it? I'm perplexed.
So again, these are Brisbane LGA suburbs. However, what I can say and report is that Belmont, Rochedale and Fitzgibbon, especially Rochedale and Fitzgibbon, they're actually areas where we've seen a lot of new estates or new developments. So, for example, Fitzgibbon is an area that was a priority development area with the Queensland state government. So what that meant is that they were fast tracking the redevelopment of the area. So within the last 10 years, we've actually seen a lot of homes sort of being built in that region and potentially higher levels of supply. So Rochedale, same, an area that was largely greenfield, but has now predominantly been rebuilt on smaller lots. And so, you know, what I wanted to point out with this is that you can't sort of look at a region and say, well, as a whole, this region performs better than the other regions. It's still really important to understand within each region what are the growth drivers. And that's what I'm wanting to point out with this graph. We can look at Moreton and, you know, if we look at the top performance of the top 3 suburbs in Moreton Bay, they've definitely underperformed in comparison to Brisbane, but they have outperformed in comparison to the Ipswich and Logan top 3. And then, you know, even the underperformers here in Moreton they've also outperformed the underperformers here in Ipswich and Logan. And I think what we need to take from this is trying to gain an understanding of why that might be. And a lot of people, and I'm a participant in a lot of chat forums and things like that, and a lot of people are talking about what's happened in the last 12 months. Now, we're in an environment at the moment where, you know, we've got a lot of macro drivers that are driving property values. So it's almost regardless of what you own, you will have seen some level of growth to some extent. And the good thing is that I have got the 12-month growth for.
Oh, no, she doesn't.
Wow, that's crazy. 61%.
Yes. Yep.
Whoa.
Can I just make a big disclaimer at this point? Because of my research background, I think it's really important for people to understand median data and the compositional bias that can exist in median data. And I really want to point this out for anyone that is tuning in. Median data is simply the middle score in a data set. So what actually sells is very relative to how that median data is made up. So, for example, you might take a suburb like New Farm, and in New Farm, you will have executive high-end homes with uninterrupted city views on an elevated ridge selling right alongside low-lying flood-impacted cottages. Now, all of those sales from the lowest value to the highest value are grouped together and the middle score is picked out. That's the median number, okay? So we've got to understand the compositional bias that can come into play when we're looking at median data. And the smaller the data set, the more compositional bias that we might actually see. So the more that data will jump around. So I just want to make that disclosure up front. But a lot of people love data and a lot of people look at 12-month growth and go, well, I'm making my investment decision based on this, and there's risk associated with doing that. It's understanding the trends and why they're happening that makes the biggest difference. But knowing how much people love data, I wanted to share this anyway. So
could you go back to the 10-year versus, if I'm looking at Ipswich Logan, I'm kind of seeing that a lot of the top performing, I mean not all of it, but a lot of it's come in that last 12 months.
You are correct.
I mean not
good spot, Jeff.
But what is there much correlation between? So
I have done the correlations, but I haven't got the numbers to report on that. So look, at the end of the day, and this is back at the 10-year, jumping back to the 12-month growth. My point of bringing this up is that, you know, a lot of markets have actually experienced growth in the last 12 months. The question to ask is, how sustainable is that growth going to be into the future, looking long term, because it's understanding supply and demand drivers to get an understanding of how much some of this growth might be sustainable into the future. Does that make sense?
Massive. It's so crazy. The just such a big difference. And where are the price ranges for these assets? So if we're talking New Farm and Hawthorn and Milton, like what kind of price range should we be expecting from some of these places?
I wish I had that written down, but your New Farm, your median value in New Farm is now over that $2 million mark for a house.
Oh, wow.
You know, so we are talking New Farm, Hawthorn, Milton, we are at the top end of the market. And the CoreLogic data up to the end of September has showed that the top end of the market in Brisbane is performing at nearly double the bottom end of the market. So when it segregates it by the percentiles, the top 25% of property values are growing at double the pace of the lowest 25% of values. So again, I don't have that graph to show you, but that's something that we talk about in our monthly blog, and that information is available on our website. Yeah.
And so can you run through just the three pillars, right? We've got Moreton, Brisbane, you said that 2 million mark. What's the Moreton price range that we? So
the price point here is probably around that median values between about 550 and 650,000 for most of these locations. Ipswich, Logan, median values a little bit less. I do actually have some median values here, and I apologise, but again, I just haven't had time to update all of the graphs.
No, sorry. I mean, you're easily the
provided them.
So if we're talking about, so by local government area, and this is
Can you take
actually
the screen down?
Yeah, absolutely. I apologize. Here we go.
There
Stop
she
that.
is. There we go.
Hi again. So median values by local government area as a whole, and this data was last updated, the data I'm about to report prior to the current boom. Okay, so we've got to add almost 20% in the top performing locations on some of these. So 22.2% has been the annual growth in Greater Brisbane for houses. I think, Jeff, on the Facebook page, you popped up something around 19.2%. That's dwellings. We've got to remember the difference between dwellings and houses and units. So houses have definitely outperformed units. So
a quick, can you give us a quick snapshot? Dwelling, houses, units. This might be a bit academic.
I've got all of that right here. So right now, median value for dwellings in Brisbane, 625,000. That's Greater Brisbane. That's all of those council regions. Yep. Median value for houses sitting at 709,136. Median value for units sitting at 430,000.
Wow.
Interesting. Yeah. Quite a good disparity. So I noticed so you picked on a couple, not picked on, but you've had a couple of areas there. There's a couple that are missing. So and it's probably because you don't necessarily look that much at them, but your Toowoomba's and your Scenic Rim. I mean, Scenic Rim's probably not a lot of. That's even sort of down. I'm trying to remember the name of that suburb where I looked at the commercial property years ago. Anyway, that's some. So you got Scenic Rim, you got those sort of areas. So is there for somebody coming to Brisbane for the first time? I suppose we can't say definite. Should they be kind of focusing a lot of their time in those three areas we just spoke about? I mean, not so much necessarily. I know Logan gets talked about a lot, but are those the key kind of areas where there's probably more data and more reliability? You can sort of pick up things.
Look, I think that there's 5 council regions that make up the most dominant portion of Greater Brisbane. That's Moreton Bay, Brisbane, Ipswich, Logan, and Redlands. Yeah. So I think as you're going out to the Scenic Rim and the Lockyer Valley, you're really acreage living. It's not an investment area that most people would target. If you're going to Toowoomba, that's not Brisbane, that's Toowoomba. It's like Sunshine Coast is not Brisbane, neither is the Gold Coast. That's not Brisbane.
And let's kind of talk about you might not know much about these areas, particularly because you don't necessarily invest in them, but just you probably know a lot more than what Joe and myself combined do. So Noosa, Sunshine Coast, and Gold Coast. What about, because a lot of people are talking up the Gold Coast. What's your kind of intel on the Gold Coast?
What's going on over there?
I would love to provide some professional advice, but my knowledge set is focused on Brisbane, and so I don't study other markets outside of the LGAs that we've just discussed. I only understand them from a macro level, and I think anyone that claims to be an expert in all areas, it's hard to the level of detail to understand all of the areas with a number of layers of knowledge becomes really complex. So for me, for example, in Brisbane, it's not just about the data, it's not just about the numbers, it's also about the South East Queensland infrastructure plan, the regional plans, the city council plans, the overlays, the intent of the future, transport modelling into the future. All of that type of knowledge helps us to form an opinion on what the future might look like for investors in certain locations. And to have that level of knowledge and that depth of knowledge, the further you become spread, you just can't
keep up.
Can't keep up. I wouldn't be able to keep up.
It's easy because I tend to agree. I was listening to Pete Orgen on Smart Property Investor podcast, and he's kind of got a service where he has people in these locations that are specialists, they're experts on the ground. And he said it's hard for somebody because he said when he moved from Sydney to Brisbane, he said it took him sort of 5 years to get that on the ground knowledge, and kind of those are the kind of things that I'm not saying you necessarily need that much, but so I'd agree with that. And what's how many? I don't know if you have a number of metrics, but how many metrics do you actually look at when you're like you mentioned all those kind of plans? Like, do you look at? Some people say look at hundreds of metrics. Do you have can you share that, or I don't know? Is that you don't have to share what they are? But
well, I think that there's a lot of metrics in property, and again, from my research background, perhaps I take a more critical view of some of the property related metrics, and whether that's right or wrong, I don't know. But for example, and I'll give you a classic example, days on market is an indicator a lot of people look at and use. And, you know, we know the number of days on market based on when a property is listed and when that property is under contract. And I can tell you right now, in the areas we're buying, it's a matter of days, not weeks, days. We're talking, you know, less than a week in most instances, unless it is listed for auction. Now, when that data comes through and it's recorded on RP data, it might come up as actually 17 or 21 days.
Because it's from when it was first listed, right? Or is that, or what's the... Until
it becomes an unconditional contract. Now, remember, the way we buy property here in Brisbane is very different. Days, right? Potentially 14 days, sometimes 7, sometimes 21. However, to me, that's not an indication of days on market if we're waiting until that's an unconditional contract to record that. So data is only as good as how it's being recorded and what is actually making up that data. And so this is a piece of data that a lot of people use to make location selection decisions. And if fundamentally the way that data is collected is flawed or inaccurate, it can actually be misleading. So people need to understand the importance of the reliability of the data, and that's just a research term, before they're relying 100% on that data. And that local knowledge is what helps to best place, you know, investors, especially in a market like we're in at the moment.
So do you track externally days on market?
For
like outside of RP data?
We don't track it for the not generally over Brisbane properties we're looking at, but we certainly know days on market for properties that we're considering for our clients.
Yeah. Okay. Agree.
How do you keep up to? Do you have like a whole team of virtual assistants kind of calling up agents? Like, how do you keep up to date with all that? Because just imagine that
ask RP data.
Oh no, we don't ring agents to find out about data. We're on the ground every weekend. We understand how many buyers are turning up to open homes, how many offers are actually being put forward on properties that we're going for. What the buyer depth is, how many days between when we know that property was listed and when we know it's gone under contract. We've got a team of 5 buyers agents that are out throughout the week and every weekend across multiple locations throughout Brisbane. You get a very good understanding of what's happening in certain pockets around the city when you have that sort of exposure and that sort of coverage.
Yeah, definitely.
What are some other data points that are a little bit misunderstood and misjudged in the property space, do you think?
In relation to Brisbane, I mean, we've talked about the median data and the difficulty in relying on median data trends over time. Days on market is an issue. When people are looking at yields now, rental yields as an indicator, when we're looking at median yields, for example, that's made up of 2 data sets. One is a median value for property values and a median value for property rents. So we've got 2 points that could be reliability issues to then calculate what that yield is. So whilst, again, these indicators can be used at a macro level to get an understanding and a snapshot view of a suburb, but a yield comes down to a property level and understanding for that property, what is that yield likely to be. There's definitely higher yielding locations in Brisbane compared to other locations and higher growth locations compared to other locations. And for investors wanting to target one strategy over another, it's important for them to understand, you know, how to measure those metrics. But yeah, Brisbane's a very different city as well, because a lot of people look at, I know in our inquiry, we consistently get, well, I want to buy, you know, I've got a budget of 750,000 and I want to buy, you know, 10 kilometres from the CBD or within 10 kilometres from the CBD. And right now that's almost impossible. You know, that brief is becoming very difficult for a rent-ready property. But
for a house at least. I mean, you could pick up of
course. I'm talking about a house. Yeah, absolutely. But I've just got a map of Brisbane that I wanted to share with you just to help.
Another one.
I've got a few surprises here.
A few goodies. Thank you for the preparation.
That's okay. So obviously Brisbane is a river city, and there's a significant flood risk associated with buying in certain locations in Brisbane. and certainly the Brisbane River, which runs from the bay all the way through to Ipswich. And in that corridor between the CBD and the western suburbs, there is a lot of flood risk that people need to be aware of, as well as some of the eastern suburbs. Now, using a measure like distance from the CBD alone is not necessarily the best tool to determine an investment grade location, because you have to also consider these other overlays. The other thing with Brisbane is that we're not a circular or a radial city. So, you know, the development of Brisbane, this map doesn't quite show it, but we've got this northern corridor and we've got a southwestern corridor of development. You can see it all the way down here to Ipswich. And then we've got this southeastern corridor between Brisbane and the Gold Coast as well. So, you know, distance from CBD in a radial measure is not always a good indicator of, you know, how to find an investment grade location.
Oh, wow.
I just sort of thought that I'd talk about the future population growth of Brisbane. And I think that a lot of people hear the words a growth corridor and think that the words growth relate to capital growth. And a lot of people use growth corridor as a term to describe population growth corridor. And back to my point around supply and demand, understanding growth corridors where the population is moving to, that's going to increase the demand for property in that area. And that goes without saying. However, what we also need to overlay that with is what is the potential for supply in that location? If there's no potential for supply and we've got all of this population growth that's projected, it's likely we're going to get upward pressure on prices. But if we've got population growth that's projected and a lot of potential for future supply, it's less likely we're going to see upward pressure on prices. So this graph just shows, this is all of Southeast Queensland. This is the 2016 estimated population. And then this is the projected population by 2041. Okay, so we're looking well and truly into the future. And we can see the distribution of where the population is likely to be not deposited to, that's not the right word, but dispersed to.
They're going to...
Distributed is probably a better word. Distributed to.
Nicely sent out to.
Just imagine playing a video game.
So this is, okay, so I'm looking at this as a newbie investor and I'm like, oh, wow, okay, where is the biggest disparity in these two numbers? Where, like, Moreton Bay looks like a good one because that, well, I mean, Lockyer Valley is doubling, but I mean, Moreton Bay's got a big old difference there. So that means there's a whole heap of supply coming into the supply coming to the
potential demand, I suppose, Joe.
Potential demand, population growth. So this is projected population growth. We're not talking about supply. We're talking about population, and that's one thing that contributes to the demand for property. Yeah.
Yes, exactly. Okay. And then, sorry, go on.
No, that's okay. So you've got Moreton Bay, you've got Logan here, you've got the Sunshine Coast over here, you've got Ipswich over here, huge population growth projected in Ipswich.
Massive.
The Gold Coast, and then this is Brisbane City Council. Now, this should not be looked at in isolation. And I think what's really important is to understand this. Now, this is all around, this is sort of a heat map for where are the corridors of future land supply throughout Southeast Queensland. So this graph illustrates where those corridors are. And I think this shows a better illustration of the layout of Brisbane. So we're not a circular city, as you can see. So this is the northern corridor of development, which incorporates Brisbane as well as the Moreton Bay region. And then this is the Sunshine Coast. This southeastern corridor, and you can see it's nearly connected now between the Gold Coast and Brisbane, and this incorporates Brisbane, Logan and the Gold Coast, and the southwestern corridor, which is between Brisbane and Ipswich. Now, the darker the colour, so the light pink, that's already established, that's the urban footprint as it exists today.
Yeah.
The darker colours here, so the red and the maroon, these are the areas where there is planned future subdivision of land. Okay, so what we know based on this mapping and based on there is a study where that I can refer to.
I thought that would blow things up. But...
Sorry, it's not a very clear map, and I apologise because I
No,
have
no,
taken
that's
it.
all right. Yeah. No.
So this is actually taken from the Queensland Government Broad Hectare Study, which was completed in 2019. So 73% of Southeast Queensland's future land supply is going to come from Ipswich Council. That's going to be 28%. Logan Council, 30%. And the Gold Coast Council. So that's the northern parts of the Gold Coast Council, a further 15%. And you can see a lot of that through some of this darker zoning and these areas through this region. Through the Moreton Bay region, there's a sprinkling of tiny little locations, and then the majority of it is to the west of Caboolture as well. Yes. So investors need to understand this. And this might help people to understand this a little bit more, because there's two different types of future supply that we can actually see. One is infill development, so that's going to be townhouses and units, and the other is greenfield development or land subdivision. So what I've got here are the 5 council regions that make up Greater Brisbane, and these graphs give an indication of whether the supply pipeline for dwellings in the future comes from consolidation or expansion. Expansion is greenfield development. Consolidation is infill development. Does that make sense? So Redlands, you can see.
You're on mute, Joe, by the way. No, Joe's on mute.
Yeah, sorry. Yeah.
So 73% of the future dwelling supply in Redlands is going to be through consolidation or infill development. 27% from greenfield development. Moreton Bay, 45% from greenfield, 55% from infill. Brisbane City Council, so Brisbane LGA, 94% of future dwellings will be infill development, units and townhouses, and only 6% greenfield. There's much less land left in the Brisbane LGA. Whereas we jump down to Ipswich and Logan, and you can see how the proportions change significantly. Ipswich, 75% is going to be coming from greenfield development, 25% from infill. And then in Logan, 78% from greenfield development, 22% from infill development.
And
now,
so
I think this is
probably worth defining. I mean, I think Joe and myself probably know what greenfield versus infill is, but is it worthwhile defining those terms, Joe? Probably for the audience.
Absolutely, yeah. What the heck is it?
Yeah, so greenfield development is land subdivision, so large new estates being developed where people will buy house and land packages. Infill development will be, higher density development, units that go up rather than land that's subdivided out, so units and townhouses. And infill development is more likely because of higher density zoning in the locations that permit that type of development.
So is let's just say if I've got an 800 square meter in close to a couple of k's of Brisbane CBD, if I subdivide that, split into 2 blocks, that's considered increasing the density, I imagine. Yeah.
That's still infill development.
Yeah.
Yeah,
cool.
Because there's an established dwelling there, and you're infilling it. You're creating, a higher density on the same land.
Yeah, I was just making sure whether that was kind of classified as more a consolidation or a green. I don't think it would be greenfield, but yeah. So just so
consolidation is basically using the same block of land to create a higher density on that block of land, whereas your expansion is actually finding new land that you can actually create more dwellings on.
Yeah, that's really interesting. And if I want to kind of, because I'm looking at Ipswich and Logan, I'm like, oh no, these are areas that there's going to be a whole bunch of land, and there's not going to. I mean, let's look at those graphs. There's not that many people. I mean, there's people moving there, of course, a lot of people moving, but also a lot of land supply. So if I'm looking at those two, because Logan and Ipswich are big areas unto themselves, is it worthwhile for people with budgets a bit lower kind of looking and sort of seeing if there's kind of gems in those areas? Or, I mean, I suppose that's a very hot-butted, tough question to ask.
It is. I'm just going to stop the sharing for a second. So I think that what an investor needs to buy depends on their unique circumstances more so than just targeting location. I think you've got to take it down to what are the capital growth and yield requirements, what is their strategy, and then what is the budget, and then understanding where you can best target a property that aligns with the budget, but also aligns with the strategy. I think that what some of the viewers can take from this is understanding the potential for future supply of a similar product type if you're buying a certain product type in a certain location. Now, of course, as the earlier data that I shared, not all locations in these LGAs will be impacted equally. It's really important for people to understand that. So, you know, as a whole, understanding within each location, you know, which are the better parts versus the parts that are going to be impacted more so. And I think these sorts of things will impact both growth in capital value potentially, but also growth in rental income potential. You know, some of the things that I have read as well around these regions, I mean, we study things like the Logan housing study, which was completed in 2020.
Oh, wow.
I mean, this is the sort of stuff that I get my head into. I know that sounds really boring, but this is really important for me to understand as a Brisbane professional, because if I'm making recommendations for our clients around where do we buy, I need to understand what's coming, what's happening, what are the councils doing. But that study that was completed, the biggest challenges for that region off the back of that study is housing affordability. It is a growing concern, and that there's many families in the region that are experiencing housing stress. So, you know, Logan has a higher, this is taken from that study, Logan has a higher proportion of households in both mortgage and rental stress compared to Southeast Queensland as a whole. And so people have to understand the demographic of who lives in a location to understand who their tenant might be or who the next purchaser of their property might be as well. And that's where getting an understanding of that really helps.
And this is something definitely I'm not qualified to talk on, but also in terms of if you're buying in a property, if you're buying in a location, you've got getting a mortgage, you have to also think, will the bank want to lend against that asset? Because there are some areas where they say, no, this area is too hot. There's not enough, it's too risky for us to take on this as a purchase. Jeff, you're the previous.
Yeah, I suppose it's kind of called valuation risk, and it's about how much potential is there that the values could sort of see a slight decline, because obviously the bank's lending at anywhere between 90 and 95%. If all it needs to do is drop 5 or 10%, and if the bank needs to repossess, it's putting itself at risk. So it's all about risk management and how much exposure it wants to those kind of areas, I suppose, or any area. It's kind of,
I just want to wrap what we just covered off in a nice little bow, because the data and the information that you just shared was fantastic. So we were looking at two charts. We're looking at one that had this massive opportunity here of demand of new people that are coming into an area, and then you showed us, well, most of that is going to be in greenfield locations. So why is infill a better opportunity for people than it is a greenfield that's being developed?
Just for clarification, that's not what I was suggesting. I think that the type of product that you target in a particular location potentially has more impact on the outcome that you're trying to achieve. For example, if I was to buy a unit in an area like Brisbane, where I know there's 94% of the future development that's going to be competing with my product that I've just purchased, that can potentially slow down the growth of that asset type. Whereas if I own a house on a block of land, and I'm 7 kilometres from the CBD, that potentially is going to be a more scarce product. Demand will be high for that asset into the future, but the supply of that asset, I know there's only going to be 6% more properties coming from house and land in that city council region. So I guess it's layering everything up. And that's what becomes important. And there's so many more layers than what I've even shared with you here, because then you've got to go to the council mapping and understand flood risk, noise risk, bushfire risk. Well, there's so many layers that then need to overlap and come into the investment decision as well.
Do you look at tornado risk after that tornado?
Tornado risk? No, I don't look at tornado risk, but maybe it's something we need to add to the list.
I don't
one of the things coming from like a Sydney mindset, is how important is the noise pollution?
So I think the big thing about the noise pollution in Brisbane is the opening of the second runway has occurred in July last year. We were in the middle of a pandemic and we haven't got airports running at capacity. Locally, anyone that lives in Brisbane will have seen the uproar from residents in some of the most premium suburbs of Brisbane, being your Melindas, your Hawthorns, your Balmorals. They are significantly impacted as a result of the change in the second runway. And there is a lot of residents that are unhappy at the moment because of the noise, and yet we are running at really low capacity in terms of what the future capacity of our international airport will be. So I think that's something that people need to be aware of, because the flight paths have all changed, although a lot of people are not necessarily aware of what that impact is likely to be once the international borders reopen, and once the state borders reopen as well, and we're actually getting back to some sort of normality in terms of the number of flights that we can expect into the future. So it's something that people need to be aware of.
Yeah, I've got a couple of sort of Sydney mindset, Sydney, Melbourne, because if I'm living in Sydney and Melbourne, and I've lived in Sydney, how important to folks or to people buying Brisbane is a public transport kind of things, and I suppose will that become more of a trend in your, we're crystal balling here, but what are your thoughts on that question?
It's a great question, and Brisbane is such a young and immature city, and in fact our transport network is one of the most established historically compared to other cities. So our train network was largely in place in the early 1900s, and that's why we built out our city that was quite geographically widespread, because we had a very established transport network. We even had trams, which in the 1960s were all decommissioned because at that time they felt we were better off building freeways and roads because more people could get around by car. I think that decision might be a decision that we now regret, because we now are starting to become a more congested city. So transport studies have shown that commute times in Brisbane have doubled in a lot of the corridors in the last 10 years. And I read things from Infrastructure Australia that provide transport modelling and help us to understand which corridors in Brisbane are going to be the most impacted in terms of traffic delays into the future. So we are going to have to rely more and more on public transport in the future, with 94% of the dwellings in the Brisbane LGA coming from infill development. The density, the number of people per square kilometre in our city is going to significantly increase. That increases the number of cars on the road, that increases traffic, it increases congestion. So if people aren't already thinking about what Brisbane's going to look like 10 years from now, that's a mistake. A lot of people are making investment decisions based on, Brisbane as it is today. And I know, one of the measures of affordability, for example, includes commute time and commute cost. So it's all great to have the areas that are these greenfield areas, but if they're in the middle of nowhere and the cost to commute to the employment hubs is significant, that's also going to impact on the affordability of that location. So, people need to not only consider, oh, well, this is an affordable location, I can afford to buy here, or I can afford to rent here, but if you're in the middle of nowhere and you have to then sit in the car for an hour and a half to get to and from work every day, that's not going to be a desirable location. And so you're going to, over time, get some downward pressure on potentially growth and rent if people don't want to live there.
Yeah, that's very valuable, because a lot of people talk about the affordability kind of narrative moving to Brisbane. I'm like, okay, that's great, affordable, but it's good to kind of unpack, well, how affordable is it for the people that are actually living there? Or going to live in these areas? So
I've actually got a study here at my fingertips. So this is an Australian infrastructure audit, a transport modelling report. So it shows the top 10 most delayed road corridors in Brisbane, and the Pacific motorway between the city and Beenleigh, which brings all that traffic up from the south into the city, is the most congested road already. And, between peak hours, 7 a.m. to 9 a.m., which is typically when most people would be commuting, and then PM, it's also the most congested road between 4 and 6 p.m. it leads me into something else that I do want to share with you, if I can share my screen once again.
Definitely can, yeah. Go on. Yes.
So this actually provides an indication of where do people live and where are the jobs going to be in the future. So I think this is really important for people to understand, because Brisbane is geographically such a widespread city, and it's really important to understand how people do need to commute in the future. So this basically shows the Brisbane LGA, this is in the middle, and the number or the percentage of people that are going to be commuting to Brisbane for work by 2040 to 2041. So, this is really significant in my opinion, because if you've got, 13% of people from the scenic ring, 45% of people from Logan, 9% from the Gold Coast, 39% from Redlands, 54% from Ipswich, and 46% from Moreton Bay coming into the CBD, how are they going to get there? And we can't rely on cars if we're going to see this huge increase in the volume of commuters on the road. And so I think public transport corridors do need to be considered now before we get to this point where we've got this huge population growth needing to get into the employment hubs. So this information, has all come from shaping or a publication by the government called Connecting Brisbane. So when we're looking at this sort of data, we also need to overlay it with where are the jobs going to be. So I've got another graph which I haven't popped in this display, but in terms of the jobs, the majority of the jobs in the next 20 years are coming into the Brisbane CBD, and the second largest jobs LGA is going to be Gold Coast.
There we go.
So, I think that that's very relevant, because as we continue to spread out geographically, it's important to understand how are we going to get into work. And if we're not thinking about public transport already, I think that's a mistake for the future in terms of the desirability of where people might like to live.
And was that something that wasn't such a big growth driver previously? Was the access to location, distance to train?
You got to throw a potential growth driver, Joe. It can't be a growth.
Yeah, look, Brisbane's, we're a much younger city than the likes of Sydney and Melbourne, so it's not something that we've really had to think about. I grew up out in the suburbs, and in fact, the way Brisbane was built was such that 30, 40 years ago, people that had more money actually moved further away and bought a block of land and built their own home, because we had very established transport networks and we had roads that were very easily accessible to get into the employment hubs. That's just the way everybody lived. And it's only now been more recently that it's become more desirable to live in the inner city locations. Now, I remember being a young girl driving into the city, in fact, the suburb that I now live, and I used to play hockey, and, the hockey fields were located in the same suburb. And I used to think, wow, we're going into where all the poor people lived. And the reality is it wasn't they were poor people. It was just the older generation, and they lived in the old Queenslander homes. And in that time, people didn't renovate them and build in underneath. They were all homes that were built up on stilts, and, they just looked old, whereas we lived in a newer home out in the suburbs, brick and tile, and that's just the way it worked. But through the process of gentrification, of course, a city changes, and as it becomes a more densely populated city, the way people live changes, the desirable pockets and locations change, and therefore we start to see a shift in the way people want to live, and that all changes the demand metrics. And of course, the supply metrics, that's also got to be considered, and the way the supply continues to change now, both in the infill development, so high density development, and also in the greenfield development, needs to be considered when we're choosing where to invest.
Wow. Yeah. Okay. It's interesting the shift. Like there's just so much. I just don't want to do any talking because every time you open your mouth, there's so much value coming out. So I just feel like I'm not going to help.
I should be answering some of the questions that some people have instead of continuing to talk.
No, it's really interesting to kind of see the evolution of a city, because your places like, I'm sort of thinking back to sort of the 40s and 50s and 1940s and 50s. I remember it like yesterday back in Sydney, and you sort of look at your areas like your Leichhardts, your Balmain, see all these kind of really grungy kind of working class areas, and they're now the areas where people are sipping lattes and got man buns and all this kind of, they got these really funky dogs, and I'm like, and you can't pick up a parking space in those areas for $3 million. So you sort of say, well, it kind of makes sense, but it's just how early in the piece are you going to be in those areas, or are you too late? And late and early is kind of a loose term, of course. But,
and we're starting to see some really crazy things happen, especially in the last few months in Brisbane. We were at an auction last night for a client. The property transacted in September 2020, so just over 12 months ago. That property, it sold for $730,000. Last night at auction, the same property, unchanged, sold for $1,215,000.
Oh yeah.
Now,
how much did the first? What did it sell for a year ago? Sorry, I missed that.
720 or 730.
So about 500,000.
Yeah, which is just under 70% in 1 year. Now, that's a very desirable pocket. It's a location where we're seeing a lot of people buy older homes literally to knock them over. They're buying for land value so that they can rebuild an executive home. And there's a lot of money coming in from both expats moving back, but also interstate people, because there's so much value in Brisbane compared to what their dollar will buy in the likes of Sydney and Melbourne, that people are actually, trying to get their block of land and being able to be, potentially within 7 kilometres of the CBD and paying that sort of price for a decent property that would rent okay, but with the intent to knock it over and rebuild in the future. We're seeing a huge demand for that type of product. So that's not the only story like that. There's been a lot of properties just recently that, have sold well above what their most recent sale has been. So, that gives us an indication of how, like when you're tracking on a per property basis as opposed to the median value there's so much bias. But when you're looking at one property from this period to this period, it gives you an indication of what's going on. Yeah.
Unchanged by via renovation or anything, any value add.
So
what is, like, actually, maybe I'll set the question up and we'll then run into our next sponsor, but I'm interested to get your thoughts on what has been the growth drivers over the past, like, what is this boom? What has caused this boom? And get your thoughts.
Overall.
Yeah, well, Brisbane overall, just Brisbane, right? Because that's your area of expertise. So let's roll into this this ad, and then it'll be great to get your thoughts on it.
Already at an hour 15 as well, Joe. I have to do some Q&A, man.
Okay, hang on.
This might be the last question.
I think this will work.
Will it? It's got the video playing.
The video?
Selling a property.
Oh, God, that's just the audio. Hold on.
That's
just the audio. Hold on.
This is our 43rd or 44th video. I suppose we haven't had sponsors for all that. But
okay.
That's why we can't.
Talk amongst yourselves, guys. I've got to find this thing. This is.
You don't want me to start answering that question. I'll hold off my answer until you've done your sponsorship.
I know we've got heaps of questions. We haven't even talked about the Olympics yet. Jeez. I don't think we're going to get to the Olympics because that's just too far away anyway. I don't know. I'm sure you'd have a very interesting answer on that.
Well, I can say anecdotally, if you want to talk about the Olympics, is that what we've definitely found is that the amount of investor or investment inquiry has significantly increased since the Olympic announcement was made. So that's not just a trend. That's definitely something that we've experienced in-house.
It's really interesting though, but it's kind of the hype, or not hype, but the event actually happening is probably driving kind of it's the FOMO. I'm going to miss this thing because there's big things happening, which is kind of the events driving the interest. I mean, probably rather than the other way around, rather than interest driving the event. I mean, I don't know.
It's like a self-fulfilling prophecy.
And the thing is, we've known that we've been the preferred or the most likely candidate for the Olympics for a long time. But it was when that certainty came and when the announcement was actually made that the investment inquiry started to lift. And, we've seen a real spike even in the lending data, Jeff. You'd be aware of this from investment lending in Queensland. It's spiked just in recent months again. So, we're expecting that trend to continue, much more affordable location. And a lot of people that we talk to, they're simply priced out of Sydney and Melbourne. So back to your point very early on around rent vesting, they actually can't afford to buy where they live and work. So they're instead investing in, areas up here in Brisbane or Southeast Queensland where they know that they can park their money in an asset that's going to potentially pay for itself, especially at the moment on interest-only lending, even in some of the better locations. If you're leveraging at 80% LVR with interest rates as low as they are, interest-only lending, most properties are actually paying for themselves. So, the difficulty will be for a lot of investors that may have been chasing cash flow. If interest rates do rise and there's been no corresponding significant growth in the capital value, then we might start to see some investors offload. And, we need to make sure that there's going to be demand and buyers for that type of product at that time. Otherwise, we'll see prices fall.
Yeah, there's a whole bunch in that kind of thing that you could re-listen to that about 10 or 15 times, people. And
I'm so glad we record these because they're a great opportunity to rewind and refresh and just try and.
Since we've got so many people watching, they'll be on our YouTube channel.
What I do love is. Well, we're going.
Sorry, Joe. Sorry, okay, I did that too early. Either.
Yeah. Okay. Hang on. We'll do the ad.
Selling a property, it isn't something we do every single day. There's actually more involved in the process than you may initially think. Like, how do you find the best agent? How do you ensure that you're going to pay the lowest fees? It's not easy, and then also throw in all the stress and pressure of selling. And that's why Scott Agate, a former real estate agent and expert property negotiator from Hello House, has created his leading agent finder service. After a 20-year career managing agents himself, Scott has personally conducted over 3,000 property transactions, along with running 3 Bell franchises. He knows all these agent tricks. Scott has created an in-depth 5-step process for his leading agent finder service. First, he establishes the true market value for your property. He uses a triangulation method to shortlist the leading agents, creates a competitive environment for those agents to send through their best proposals, vets those proposals, and then he negotiates the best agent fees for you. This ensures that you're not only getting the best rate for selling, but most importantly, you have a leading agent on your side selling your property to maximize the end sale value. Oh, and did I mention, this service is completely free. If you'd like to know exactly how Scott runs his 5-step leading agent finder service, he's detailed it with the link below. Or if you'd like to speak with Scott to help find you the leading agent in your area, book a call today.
I don't actually have that link, Joe.
Well, it's not just me that messed up tonight. The only person that hasn't is Melinda. You've been absolutely fantastic. What are you doing, Jeff? Oh, here I am.
I'll kick you out, Joe.
Please. I think it's best. I think it's best. And I'm just looking at the questions. We got a whole heap of questions. But yeah, I'd love to get your thoughts, just a high-level overview. Like, what has been driving this Brisbane, this boom for the areas that what are your thoughts on what's been driving it?
Well, I think that there's been a lot of macro drivers that have stimulated all property markets around Australia, and those things include low interest rates as obviously the most obvious macro driver. When people have the capacity to borrow more money and they also have the capacity to borrow cheap money, it's going to provide a stimulus for property markets around the country. The thing that Brisbane has that it's a little bit different to other locations. I spoke earlier about the peak oversupply that we had in that inner city unit market that came through in 2016. Since then, the number of new dwellings that have been approved by council and also, coming through in new building approvals, it's been declining, and the number of completions has also been declining. So we've been in a situation where whilst the population has continued to grow, we've actually had declining supply, especially in that higher density unit market. So we've now got a situation where, even with the borders being closed, and especially the international borders, we've had interstate migration. So Queensland, especially southeast Queensland, has been the recipient of a lot of people off the back of COVID, lifestyle change, etc. So, we've still had that putting demand pressure on properties. We typically see that coming through in the rental market first, and we've got the perfect storm for investors. We've got really low vacancy sitting at 1.4% at a citywide level, but a lot of suburbs we're buying, vacancy is less than 1%. So there's nothing to rent, so there's upward pressure on rents.
Or is that houses, or you're not?
So that's just dwelling vacancy rates. Now, there definitely are pockets, don't get me wrong, there's pockets where vacancy is elevated. Typically, those pockets are areas where international migrants will come and rent. So they're a demographic that is from another demographic group, if you like, so not necessarily from Australian descent. So, and we've also got pockets where there's higher density developments where there's still elevated vacancy risk. In fact, the Brisbane CBD, it tightened in terms of the vacancy back in May, but since then it's been elevating again. So vacancy trends do change month to month, but in the housing sector, and we've seen that trend where people wanting to move into the houses rather than units as well, there's been really tight vacancy. So, we've had those macro drivers, but then at a local level, we've had this declining supply or new supply as we've had these increased, demand. But you can't forget that we've had a much better COVID response. We've not been locked down like Melbourne and Sydney. We haven't had those significant periods in lockdown, so we've been able to move around more freely. We've got an improving economy, as the rest of Australia will have now coming out of those lockdowns. But we've also got a very affordable market, and I think people underestimate the price differentiation that we had until the beginning of this boom between Brisbane and Sydney and Brisbane and Melbourne. And I think people are just starting to wake up. And the last time we actually saw such strong price growth was back in sort of 2003 to 2005. We saw significant price growth in Brisbane. And at that time, there was a huge price disparity between Brisbane and the other southern states as well. So it's like Brisbane's doing some catch up. People are finally seeing some value as consumer confidence has increased off the back of COVID lockdowns and things. People are seeing property as a stable asset class, and Brisbane seems to be appealing. And then, of course, when you get things like the Olympics announcement providing some certainty for a longer term investment horizon, it just gives people the confidence to make those investment decisions. So I hope that's answered your question, Joe. But every local market's a little bit different, and I think that Brisbane's just had a lot of the right, balance going for it, and that's why we've seen this strong price growth. And I expect to see Brisbane continue to grow strongly in the months ahead based on what we're seeing on the ground. The buyer depth is still so strong. I mean, some properties that we're putting forward offers on, the most competitive we've had recently was 44 offers on one property, but it's not uncommon to have 15 or 20 offers on a single property. Now, that tells you for every buyer that misses out, they're still in the market. Yeah. And to see price growth slow down or stabilise even, we need to either see a huge increase in the number of properties that become available for sale, or we need to see a decline. We need to see the buyers drop off. So even the most recent APRA announcement, I really don't think that's going to have a significant impact on the Brisbane market, especially in the market that most investors are targeting, perhaps the very top end of the market, but most investors aren't in a $2 million price point in Brisbane anyway. So people have to consider how it impacts property in a certain location. And if anything, I feel like it's just going to move people down a price bracket as opposed to sort of dampen that demand for Brisbane.
Which might even just drive more people out of other locations into Brisbane.
Possibly.
Yeah. Fingers crossed.
I don't know. I don't want any more buyers coming into Brisbane. It's competitive enough as it is. So feel free to explore other regions, everyone.
I like it.
So I reckon should we kick on into questions, Joe? Because please, otherwise it's already definitely. Because we had a whole heap come through prior, but I think we've answered some of those. So let's.
I was looking at some of the income ratio, like the house price and household income, And Brisbane, you got Sydney, we're at 10.8. So median family income's 107,000 and Sydney median price is 1.65. So it's a 10.8 times income to price ratio. Brisbane, you guys are at 5.3. So you're just so much more affordable. And as well, Sydney and Melbourne have a lot of capital. They've got a lot of cash. They've got like a lot of higher income earners, you know, just generally speaking, right? But those people are now saving a whole heap of cash, but they still can't afford. They're single professionals. They still can't afford a $2 million property. So where do you put that
closed, and especially
big
the
amount of
international
savings? And then, you move it to Brisbane.
Yeah, it's pretty much what we're seeing. And a lot of our inquiry are cashed up interstate investors wanting to park their money somewhere and put their money into property, and they can't afford to buy where they live. So they're looking at, locations that they can afford to buy and get a decent rental yield as well. And I think, if investors have got a strong budget, even if they've got 1.5 million to spend, of course you can buy assets in Sydney and Melbourne, but you're not going to get the same yield. And I think that's the other thing that attracts a lot of investors to Brisbane. Not only do we have strong growth prospects right now, the gross yields are actually a lot more attractive than the likes of Sydney and Melbourne. So it does drive the investment dollar up this way. And because we've got upward pressure on rent, so in the last 12 months in the housing sector, we've seen 10.8% growth in housing rents, 22.2% growth in capital value. So 10.8% growth in housing rents. We're seeing yields start to compress. So at a citywide level, gross yields are sitting at 3.9%. Again, that's all of Greater Brisbane.
It's kind of what you want, because that means the capital's increasing.
Correct. Yeah. So,
rental eventually probably have to catch up. Maybe they won't.
Yeah. So that's
and
actually that's very interesting what you just said there, is like you can buy a $2 million property. Well, let's just say a $1.5 million property in a location in Sydney. And it's it's probably not going to be the best location for your actual capital, because there's places elsewhere out in Brisbane where a $1.5 million budget could get you into that next tier of that first chart that we looked at, if everyone remembers, that was 126%. I haven't really thought about it.
Not financial advice, folks. Everybody has
it all.
Well, one thing I always say to our clients is that where you buy, so the location that you select, does about 80% of the heavy lifting for capital growth. What you buy, meaning the product that you buy, does the balance, but typically will create the rental income. So, location selection is really important for any investors that are chasing capital growth. Yeah. I know that there's some locations that will give moderate growth and moderate yields, but, we track at a suburb level and at an LGA level in Brisbane what's going on in growth and yield, what's going on in growth and rental price growth, and therefore yield over, a 10-year period, a 5-year period, and a 12-month period. We always track that in-house, and I can guarantee 100% with certainty that there's an inverse relationship between capital growth and rental yield. So when we look at that, location being the highest growth location in Brisbane, gross yields there are less than 2%. It's more representative of Sydney, but if you're going to be looking at some of the locations that might have been the lower growth locations, you could potentially get yields upward of 6% in those locations. So, an investor needs to understand what is it that they're trying to achieve. And I think a lot of people, when they are trying to determine what to buy, the big piece of information that a lot of people forget to focus on is, how does this impact my tax strategy? Because if I'm buying in my own name, I need to understand from what is the gearing position and how is that going to impact my tax? Because the thing that breaks my heart the most is that when you see very high income earning professionals buy high cash flow properties in their own name, sometimes to me that just does not make sense, because you're actually then going to be paying so much money back to the ATO every year, but you are going to compromise on the growth. And, there's people that will argue black and blue that what's happened in the last 12 months is indicative of, the fact that some of these areas might grow in value. But yes, when the rising tide does lift all ships at some times, of course, but when you can see what's happened in some pockets versus other pockets, it's very important to understand that over a 20 or a 30-year period, the difference in 2% or 1% compounding capital growth can actually be hundreds of thousands of dollars. And I've written a blog about this, as opposed to, just an extra few hundred in rental income along the way. So I think investors need to get clear on their strategy before they start building out a portfolio, and make sure it aligns with their personal circumstances.
Yeah. It's just the evolution of, like, I think people that build portfolios, there is that evolution. It first starts at house and land packages, because that is the most amount of advertising, and then it goes to off the plan apartments, and then it goes to high cash flowing, yielding places in the middle of nowhere, and you just kind of
invite your friends and family though to Oz Property People, because we can kind of buck the trend a little bit, I suppose, hopefully.
Yeah, well, I guess that's why we created it. That's why the group exists, to get rid of those people with their big marketing budgets and send them all here, and we'll
maybe
educate
one day
you.
we might have a big
Amazing
marketing
people
budget too, and
like Melinda. Let's hit some of. Look, I'm very appreciative of your time, Melinda. It's an hour and a half. This is crazy. So Jeff, you've been looking at those comments. Let's hit some of the top ones.
Yeah, I mean, there's a whole bunch of people that are asking what and where to buy for a thing. I don't know. Like, I just don't think that they're the biggest bang for our buck to the question.
Okay.
So really,
here's a good one, Melinda. What do you think about spending $3 million in Brisbane rather than Sydney, Melbourne? Is that a budget?
That's kind of where to buy, though, Joe, isn't it? I mean, I don't know. Is that...
Well, no. Would you break that asset down or would you go for one big chunk of $3 million for an asset, or would you break it down?
$3 million is an extremely high budget for Brisbane for an investor. So would I be buying one $3 million asset? I need to consider who's going to rent that property. Am I going to have vacancy risk if I'm buying the $3 million executive home? Possibly. You've always got to consider who's going to rent the property, and you don't want to create vacancy risk by, if someone's got $3 million to spend, they're probably going to buy their own home and not need to rent. Breaking that down into two $1.5 million purchases potentially could be another strategy, but it all depends, and I can't even say what I would do, because if I was sitting down to you, Joe, and you had $3 million to spend, and I was sitting down with you, Jeff, and you had $3 million to spend, my advice actually might be quite different, because what's important for me to understand is, well, what's the purpose? What are your goals? What timeframes are we working with? Do you intend to, manufacture any equity along the way? What's your exit strategy? And by the way, what's your income? How do we make sure that we're aligning the finance to the investment strategy, and so we're not compromising the tax strategy along the way? So it's really hard to answer those questions, because it depends. But to my point, one $3 million asset in Brisbane, you are talking the very top end of the market for Brisbane. So you need to then consider who would rent that property. And if you're considering the demographic in the area and there is a market to rent that property, and you can reach out to local property managers to get that sort of information, of course, then if that's the right strategy for you, that's the way you go. Alternatively, you might look at other people might argue you could look at $10,000, $300,000 properties. I will not be one of those people that contributes to that argument.
Can we sort of, I'll throw in a question, and maybe we talked about it a little bit, but we could quickly recap. So which I don't know, you may not want to answer this question, but which LGAs to avoid? What are thoughts on the red? I think I know your answer to these questions, but it's basically look at the graphs, go back about an hour, and that'll probably give your answers to the question.
Well, not always, because again, I think it does come down to why an investor is actually moving into property as an investment class. Because for some people who may be on lower incomes and they need to rely more on serviceability, cash flow does actually become important for them. Otherwise, they may not be able to afford to get into the property market. So, if you've got a lower price point, you've got to actually understand, well, what will your money buy? And you've got to potentially look at the best asset for that budget. And again, it does come down to personal circumstances and personal tax strategy and how that finance is set up. So if that means that you need to compromise on growth to some extent because you need a certain yield, and we see pre-approvals all the time, and a lot of the time they're conditioned to a requirement of a certain minimum rent per week, which means you won't get funding unless you actually achieve that yield. Well, you can't go and target a certain location that's not going to deliver that yield if you're conditioned to that for your finance. So I think that it's relative. There's no LGAs to avoid It just depends on what strategy is actually going to be the right strategy for you. Capital growth is a strategy. Cash flow or targeting income is a strategy. Where you are in your portfolio build might determine which sort of strategy is best for you at a certain period of time. And as one of your advertisements shows, there might actually be other types of properties, commercial property, industrial property, for example, that might be a more attractive option if yield is something that people will target. But again, that's all going to be relative to price point.
Yeah.
So I haven't answered that question at all because I really can't, because, you know, it depends.
This is what we get all the time in the group. And it's one of the biggest things like that people just go to, right? It's like property investing, boom, asset. Or location.
Which location should I buy? It's like, well, that depends. What are you trying to achieve?
We may be working on something like this, but we don't know. We may or may not be as well. But I'll just throw it out there. The second part of the question, I would be very cautious. I'm not saying no to that, and I don't even really know Redbank Plains, but just be very aware of the supply potential coming on. And so wind back through the session, look at and just consider if that fits what you're looking to achieve, Cara. That's what I will.
And I'll also add that when you are buying in a brand new estate, effectively the developer controls the land values.
You know about developers. Scott is a developer or has worked in the construction?
We let's not be sexist about this. Yeah. Scott and I are property developers.
you are probably the better developer, I would say. I think you look at the numbers and that sort of stuff.
Yeah, let's just keep digging this hole, Jeff. Let's just keep digging it.
Let's just change the subject. But what I will say about new land estates is that, generally developers will release each estate in stages. So when stage 1 is sold out, then they'll release stage 2. Now, you've got to remember that in most instances, the land appreciates or goes up in value at a slower rate than the building depreciates. Now, the other thing is, since the government changed depreciation laws recently, as once you own an asset, it's becomes secondhand. If you need to sell and then, an investor can't claim those depreciation benefits, that's going to be negatively impacting you if you need to sell in the first few years. So it's something you have to consider as well.
And if you're even being the second person buying that asset, even more so, it's those depreciation benefits just aren't there because the government. I mean, there are depreciation. Speak to a depreciation specialist.
MCG, Mike
Mortlock.
He'll help you out.
Bloody love Mike. Oh yeah, you did some great data with Mike. Actually, great article. Everyone, check out. Go on to, I think it's Melinda, your LinkedIn or Mike's LinkedIn. You both did an article together.
But
I think it's on both of our blogs too.
Yeah. I've linked to. Somebody asked to link to your blog, so I put that in the comments so people can check that out. So people are asking a whole bunch about locations, and Mitch has asked about Kalanga and about the mill, and it's too hard to answer that. It's not too hard, but it's just. And somebody said, let's say targeting 6%, what realistic growth one can expect? That's too general a question. I'm sorry, Tone, but it's too hard to say, even if you gave us a suburb. And Scott, who he said, what are your thoughts? I think I know your thoughts on this, but he said, when do we buy our bargain unit in Brisbane City? I think we
bargain unit.
Yeah, I'd be very cool. Bargain and bargain value. I don't. Yeah, I mean, they don't go hand in hand for mine generally.
This is actually one thing I would like to touch on, because a lot of people reach out to us and they say that they would really love to, engage our services so that we can negotiate a better deal. There are no bargains in Brisbane right now. That's really important for people to understand. If you are able to buy a bargain, I'd be really concerned about what you're buying, because everything that we are buying is competitively fought after. So you will have multiple buyers competing for quality assets right now in Brisbane. And so if you're buying something with no competition that's listed on the market, that's a massive red flag for me, because if you need to sell and it's a buyer's market, it's a seller's market right now, If you need to sell in the future and we're in different market conditions, then who's going to buy that?
Yeah. So if your phone rings and it's the agent saying, "Hey, I've got this great property for you," you're like, I don't know.
Agents are not very interested in buyer's agents at the moment. They don't need us.
Not at all.
There will be a time when they will need us and the phones will start ringing again, but we're just another buyer in the mix at the moment. And, the other thing people say is that, I want you to get me an off-market deal. Well, yes, we buy off-market. A lot of buyer's agents sell their whole service by saying we buy this proportion of properties off market. We don't talk about that in any of our marketing, because sellers are not silly people. Sellers know what is going on in this market right now, and sellers will not sell for a bargain. So to buy off market right now, generally you actually need to pay a premium to stop it from going to the market. So then you have to assess whether there's greater risk in paying that up front or letting that sales campaign run its normal course. Of course, there's still opportunity. Sometimes there is opportunity because of sellers' circumstances where you can jump in and potentially buy something that if it was listed in a normal marketing campaign, you may have had to have paid more. But that is not something that we would ever advertise, especially in a market like today, because it is a very, very competitive market in Brisbane and there's no bargains.
So here's a question. How do you get these properties? Like, how are you actually negotiating? Like, what are some of the tips and tricks that people out there can try and use in their own day-to-day to help secure some of these assets? Because it is hard out there. You've got 44 people bidding. How do you do it?
Well, have the biggest budget. So when you're bidding at auction, literally you need to have the highest budget to be able to secure a property. And when a property is listed for sale by private treaty, there's definitely things that you can do to be more competitive with offers. And the biggest advice I give to anyone is be finance ready. Sellers want certainty. So the more competitive you can put forward your terms, the more favorably your offer is going to be considered. But, at the end of the day, there's a lot of frustrated buyers in Brisbane because they really don't understand what they need to pay. And the disparity between entry-level offers and the offer that ends up winning the property can be huge, because a lot of buyers just don't understand that you can't look at a property that sold 2 or 3 months ago and use that as a comparative sale. You just can't do it anymore. You have to apply the growth that's occurred in that location to that settled sales information. Otherwise, you'll just miss out. So,
and that must be hard you got to set that expectation, I guess, with the client to be able to say, like, this is actually what it's going to be. You want a great deal. You want a great bargain.
Of course,
great. This is the long-term value that you're going to be getting. So you have to pay at this rate.
Where we add value at the moment is getting people into the market faster, not by negotiating a bargain. There is no negotiation. Everything's multiple offer. So what you need to do is make your offer as competitive as possible, because when you've got a pile of 20 offers that a seller needs to sift through, you want yours to be the most appealing.
Definitely.
And it's pretty hard as investors. And I'll tell you what happened to us yesterday. We lost 2 days ago. We actually lost a property, even though our offer was very competitive in terms of price and terms. But they went with another offer, which was a home buyer who wrote a letter and it connected emotionally with the sellers. Wow. Now, we can't compete with that if we're working with an investor, because I'm not going to lie. But it is something that people are starting to do. That's how desperate people are becoming.
Kind of like Cialdini, the influence, those 6 kind of, Bob Cialdini's book. We've had one thing that I want, and sorry, Tony, he really wants us to smash this kind of 6%, what growth, 6% yield. It's not the kind of, I don't think that's the kind of question that we could go around in circles talking about that one. What I do want to talk about, though, is Queensland and working from home. So Jerry's brought up an issue. You mentioned the importance of infrastructure for transport in Queensland, but do you not think work from home will reduce the reliance on public transport? And somebody asked that probably half an hour ago as well. So what are your thoughts on work from home? What's it like?
Look, I think we all have an opinion on what the future could look like, and no one knows for certain what that's going to look like. I think that there'll be a gradual trend as we move out of the other side of COVID for people to resume some sort of life as it used to be. And, ultimately there's going to be a level of flexibility. But even if you have to commute for 3 or 4 days a week as opposed to 5 days per week, there's still going to be that requirement to be into, the areas where the jobs are located. And look, a lot of jobs can't be done from home either. So, that's my opinion. No one can prove with fact right now, looking into the future of what might happen. So we all have an opinion on how that might go. But, we've had a trend in the last 12 months where people have actually wanted to upgrade their homes because they wanted the ability to have a dedicated office space. And so we've gone back to that. We want a big home on a big block of land again. That's the trend in Brisbane. And that's why the demand for that type of property has spiked. And whether that's a long-term trend, it's too early to tell.
Perfect.
Are you looking forward to the census data coming out in a couple of months? Or?
Yes, because I rely heavily on the census data. And I know we've done I'm a 10 out of 10 girl for action. So knowing that they've got that data and they just need to release that data, I'm really looking forward to seeing what that shows.
There's Polizzi's token comment. Why isn't cereal considered a soup? He throws that in every week.
What is that, sorry?
Steve Polizzi. He jumps on he says, why isn't cereal considered a soup? He loves. I don't even need to read who it's from. What are your I want to ask you selfishly for Polizzi, just to kind of get you might not have any ideas or thoughts on this, but have you ever thought much about commercial, or you haven't kind of delved into that down that path?
Yeah, look, we own industrial property personally, and it's something that I believe a lot of investors, it can be a good option for some investors depending on their strategy, especially to transition to in the latter parts of their investment journey. So, in terms of the opportunity for Brisbane, I think it's commercial. Obviously, there's 3 segments: the industrial, the retail, and the office space. And I think they're all quite different in terms of what the demand drivers are. We also do help a limited number of buyers with commercial buyers advocacy. It's not our mainstream. Typically, we target more businesses that are looking to relocate and get into that, because most commercial assets come to the market anyway. So there's less value that we can add by going down that way. So what's my opinion? I think that there's a strong pipeline. I think the way we do business in the future is potentially changing. So you've got to think about the type of commercial asset that's going to be required or in high demand into the future. And if my personal opinion is that industrial assets, because we rely more on, storage, warehousing, that sort of thing, I think there'll be continued demand for that sort of thing into the future. To your point around working from home, office space, things like that. It'll be interesting to see how that plays out into the future as well. But that's sort of been the area where there's been greatest vacancy off the back of COVID. Of course, moving into commercial real estate investing, yes, there's definitely higher reward, higher incomes that come with that, but there's definitely higher risk. Let's not forget what happened during COVID. Commercial property owners had to pitch in for the cost. It wasn't as bad for residential property owners. The Australian government protected residential property owners. They protected residential property by putting those mortgage freezes in place. As commercial investors, we had some benefit of mortgage freezes, but we had to share the cost with our landlords. So, our tenants. So it's really important for people to understand the risk and the reward before they consider a certain asset class and whether that's going to align with their risk appetite and the goals that they have.
Yeah, I totally agree. I think we've got probably the question that leads into the next question. Do you want to pop that one up? Melinda, do you help with investment plans as well as being a buyer's agent? We're looking for an investment house number 3. So Melinda, give us a bit of a rundown of your business, because I know we've been speaking about on that outskirts, but give us a rundown. What's the business? How can people get in touch with you?
Sure. So our business is Streamline Property Buyers. We also run a podcast, weekly episodes, the Brisbane Property Podcast. So if you want weekly updates of what's actually happening on the ground, please subscribe to our podcast. It's the best way you can get those information snips. Within our business, we started as a husband and wife team. Scott's a licensed builder. My background is research. We're both from construction and residential development. We're now a team of 5 buyers agents, assisted by 2 administration staff. That provides a lot of leverage for our clients. 2 of our team members are qualified property investment advisors. So do we provide investment plans? No, we don't actually write a written plan for the reasons that I outlined earlier. What we do is provide investment strategy, and we do that through a tailored investment. We do that through a one-on-one session. I conduct all of those myself with clients. The most important thing for me with property investors before we move ahead with a search is getting clarity over the brief. And we do that through that tailored session, because I want people to come back in 3 years' time and reinvest by using our services. And the way that they will do that is ensuring that the asset we help them to buy aligns with what they're trying to achieve in the future. So I hope that answers the question.
Yeah, absolutely. Absolutely. Yeah, I think, and you got us on playing us through the echoing, Jeff. You echoing us. But why Streamline? How did that come about? I'm interested. I love
the name itself.
Yeah.
Yeah, so we just wanted to actually make the process streamlined for property buyers. So we do work with home buyers, of course, as well as property investors. But, you know, people don't buy property every day of the week. We do. Well, maybe not every day, but every week. And we need to make that process easier. And that's what we do when people actually partner with us. And it's not that we work for people, we partner with people, and we help people to be informed about that property buying process. So we do all of that due diligence, that price guidance, the negotiation, but it's always under instructions from whoever has employed us to work with them. So the name came because it really is just about making that process streamlined. So that's where it came from.
Makes perfect.
Pretty simple. There's no fancy story to it at all.
I like it.
That sounds pretty streamlined to me.
Yeah. Nice.
I've just got. Can I share my screen just to show that if people do want to get in touch? This is where they can go.
Streamline.
So this is Streamline. This is our podcast, streamlineproperty.com.au. There is a link to our podcast from the website, or you can also find the podcast on all of the players, Spotify, iTunes, blah, blah, blah. So that's probably the best way to get a better understanding about Brisbane, if you want more information, of course. And happy to share that information.
Thank you for being a big part of, I suppose, the journey of my journey. Us chatting a couple of years ago, so I really appreciate you jumping on and always just adding value. I see you across a couple of forums here and there, and you're always about just giving back. So we'd love to have you on again at some stage to give us a bit of a Brisbane update as well.
Yeah,
no worries.
Yeah, that was
great.
Fantastic. Amazing.
Hope that people have taken some value from the information that I've shared. One thing I never do during these sorts of sessions is give suburb-specific information that is obviously reserved for the clients that we work with. But, you know, I do like to give people a broad overview and understanding of Brisbane, because when people are investing like Sydney or Melbourne investors in Brisbane, sometimes that can be a mistake. So I hope that's been helpful. And, thank you so much for the opportunity to chat to you both tonight.
Yeah, I loved it. That was fantastic. And a lot of unique data that you shared with us is a lot of it's from your business as well. So that's a good point. Like, not a lot of it is just out there ready to go. You actually pulled this data, collated it, and it's all within your business. So thank you very much.
Personally, not me, but I do have a wonderful assistant over in the Philippines who does collate all of this data for us. So shout out to Paul. She's amazing, and she does so much spreadsheeting for me, and all I have to do is interpret and graph data.
People do ask if they could get access to it, but I think that's probably
access to our data,
or just the presentation. The presentation.
Watch the YouTube, as Jeff loves to pump. We have a YouTube. Yes, was it on the YouTube? You'll be able to see it there, baby. Actually, they might be in your blog, Melinda.
A lot of the information that I have shared, if you take the time to go through the podcast specifically, and then a lot of the podcast episodes are also a blog. There's a lot of content on our website that people are welcome to digest.
There you go.
There it is.
Yeah.
Amazing. Perfect. Okay. Well, see you guys later. Thank you very much, Melinda. Let's go buy a property in
Thanks.
Brisbane.
Don't send all your buyers up